Hey guys, and welcome to Forex Market Analysis session. In today's video I will analyze Euro-Yen 4-hour time frame chart, and I will show you a trading opportunity that I'm looking at for the next week. And let us start. This trading opportunity is based on a Gartley pattern, and I should first explain you my rules for a Gartley pattern that are based on backtest. Okay, I don't pay much attention to the B point ratio and to the C point ratio because in my backtest I found this non-significant. Depending on the B point and the C point ratios, you simply change your entry, but you should backtest all possible Gartley pattern variations, and there is no regularity for the D point. That's why when you hear somebody saying that if the B point is 0.5, then the D point, I mean the reversal, should be 0.886. This is not based on market research. This is based on some mental, maybe logical thinking or whatever, but this is not based on market research. 100% objective market research that is done by different swing identification algorithms, different periods of these algorithms. I mean not only smaller patterns but also larger patterns within the same algorithm family, and analyzed absolutely automatically by pattern optimizer, who actually backtests same Gartley pattern variations with different entry stops and targets. Yes, and then it simply shows the best for this pair, for this time frame, for that thing. As you guys know, that there are as many B point and C point ratios as there are traders. Of course, some traders may switch B point and C point every, I don't know, every decimal, 0.3 to 0.4, 0.4 to 0.5, 0.6 to 0.7, and so on. And some traders may switch them based on Fibonacci, 0.32 to 0.5, 0.5 to 618, 618 to 786, 786 to 886, and so on. So based on that, there are many ways of this kind of graduations of what can be possible B points and what can be possible C points. So in my market research I use decimals, 0.3 to 0.4, 0.4 to 0.5, and so on. So the B point and the C point, they were decimals. And using this very specific, using this very narrow variations of a Gartley pattern, there were different, absolutely different D points, I mean the reversals, that are the best for these variations. And actually total number of pattern variations multiplied by total number of possible ways of trading it, with possible entries, possible targets, and possible stop losses on 30-minute time frame, it is 10 million patterns variations. On 1 hour time frame, it is 5 million pattern variations with all possible entries. It is absolutely non-achievable for a human being to do that kind of backtest manually. Luckily, I am a programmer as well, and I coded a specific software to do that, and this software is called Pattern Optimizer, and Pattern Optimizer is the source of my knowledge. Of course, initially I got some knowledge about Gartley patterns from some books, some webinars. I attended different courses, paid courses and free courses, but later I switched to my own market research in order to find out the truth, to find out the objective results, because I was not satisfied with the information I was provided. Well, so in this video we have that essence of my understanding of how I understand. That's why the B point and C point, they are wide here. the D point. I type this as 0.75. If you guys familiar to 0.75, it is the same as 3/4. One of the things that I noticed in the backtest, both using the MPS and pattern optimizer, is that Fibonacci seldom works. Price either crosses the Fibonacci level or it reverses slightly below the Fibonacci level without touching it. But price reverses exactly at some decimal levels that can be identified as parts. And what are these parts? There is half, there is 1/3, 2/3, 1/4, 2/4, 3/4, 1/5. So these parts that are easily identified by our brain without any measuring, without special tools, we can easily identify approximate half, we can easily identify approximate 2/3 or 3/4. So these levels work better than Fibonacci levels. Another thing is that I'm not using stop losses, predefined stop losses here, and targets here. I will explain you why, because they will not be standard stop losses and targets in this trading opportunity. That's why I disabled them. Okay, that's it about a Gartley pattern that you should know about, and let me draw that pattern. So the pattern looks this way. So first of all, the time frame. Before you draw any kind of pattern, and if you are not going to set a limit order, if you are going to use some price action to execute your trade, you should calculate the number of your candles. And the best number of candles is 50 to 80. 50 to 80. So in this case, you will not have that situation. For example, let me switch that to 5-minute time frame. You see that that whatever candle, if you switch that to 5-minute time frame, you have gaps, you have powerful bearish closes. If you switch that to 5-minute time frame, you will find your candle that will signal that a reversal started. Of course, even if you switch to 15-minute, you will also find some reversal candle. So even 30-minute time frame shows you some reversal candle. So how do you find an optimal time frame? Simply based on this number, from X to D, you should have 50 to 80. So let's calculate that. Right now we have 53. So if it will terminate here, we will have approximately 60, maybe, or whatever. And the second clue, second guideline, is to use minor price action. So we don't know the reversal point, the exact reversal that will happen. So we should have some clues looking at previous price action, looking left. And what we can see, we see this range. Some kind of retracement. Yes, so let me draw it here, that we had inside of this XA leg. And according to my market research, these breaks of the impulse leg of a swing, these breaks of swing, they act as good reversal points. In many cases, price reverses exactly at these levels. So how you should treat these levels? Let me explain it to you. Oh, come on. So you should look further left and optimize your level. And let me show it to you. So how do I personally optimize this? I want the lower border to serve as good support resistance. Support, resistance, resistance, support. As good support resistance. The more levels it touches, the better. Okay. we should not have full candle body above or below crossing it. If we have a reversal, we shouldn't have full body. So like here, we had a kind of crossing, and then we have full bodies here and here. So this means that the level was broken, and it should be kind of lower here. And the same stuff we should do with the bottom. So it can be spiked, trying to touch as many candles as possible. Yes, and now we see the price action here. So what it looks like, we had some kind of support here, resistance here, then we had some kind of support here with this spike, and then we had resistance here. So the upside border is the second retracement. So between these retracements we should have some kind of reversal. Okay, then you should of course have some understanding of what is a breakout. A breakout is the first powerful bull close candle above your support or above your resistance. So let me draw it this way. Okay, come on. So this is our first support resistance level. This is our second support resistance level. I'm trying to unite as many candles as possible. Okay, so this is first support resistance, this is second support resistance level. So do we have a breakout of the lower support resistance level? I would say not yet, because according to my rules we should have powerful bull close above this level, the candle that has powerful bull close above this candle. So what is a powerful bull close and what is a powerful bear close? It is very simple to identify. You can also identify that mechanically, and if you will type some comments below, I will also show you how you can identify that mechanically, coding your own indicator to draw them automatically. Okay, so what we have in the candle, we have low and we have a high. So let's suppose that this candle is a range. Our low is 0% and our high is 100%. 100%. Okay, then a powerful bear close is the close that is somewhere in this range from 20 to 0, and the powerful bull close is somewhere here from 80 to 100. Very simple. From 0 to 20, from 80 to 100. This principle is called a stochastic principles. Actually, stochastic is this kind of calculation. What we have in stochastic indicator is that we calculate the powerful close, the power of a candle close for previous several candles, for example 14 candles, and then we use some smoothing using some averages to smooth the fluctuations. Yes, okay, so any candle that is in the top, closing in the top is powerful bull, closing in the bottom powerful bear. Okay, so let me delete this stuff and now let me draw some candles as examples. So suppose we have a powerful bear candle and it has a close here. So does it matter where open is? No, it does not. So if we have a candle that opens here and then it trades and closes here, is this a powerful bear candle? Yes, it is powerful bear candle. We have it this, maybe here, powerful bear candle. They are called trending candles. So this one, maybe this one. Okay, if we have it this way, if we open somewhere in the middle and we close in the bottom, is it a powerful bear candle? Yes, it is. Look at this one. Yes, we open closer to the middle and we close closer to the bottom. So all candlestick formations, they are based, look at this example as well, they are based on this stochastic principle. You can call it morning star or whatever, and if we have lower close, you can call it doji or inverted hammer or any other type that you like, any other name that you like, but it will not change anything. The thing will stay the same, that the powerful close stays powerful close regardless of what is your open price. Okay, and of course to calculate that, your range of the candle should be the average one. When you have very small candle and you calculate your range, this will give you some information that is not reliable. So your candle range should be average. Should not be very small, or it should not be extremely large, because extremely large candles are expansion candles, and they can be climax candles or whatever, and we don't have any continuation after these candles. A bit random here when the candle range is small or it is extremely large. So it should be average, moderate. You can use ATR to measure that. So if the candle range is more than 2 ATRs, for example, then it is extremely large. If it is less than half of ATR, then it is extremely small. So this is how we identify bearish candles. So this is a bearish sign. So what is the bullish sign? It is powerful bullish close. So you should have a close here. Of course, if you have open here and close here, this is so-called trend candle. Yes. If you have open here, close here, this is a what? I don't know how this candlestick formation, piercing pattern or whatever. Yes. And when you have it this way, what is it? A hammer pattern. After that we have some reversal after that hammer patterns. Okay, to the upside. Well, and what if we have our close in the middle? It is indecision. If you open here, you have indecision. If you open here, you have indecision. If you open here, you have even greater indecision. Okay, so now you know how to read price action. Now you know how to read candles, bars, or whatever. Doesn't matter. And now you can identify when a reversal starts. As I told you in the beginning, yes, that of course you can find your confirmation, your candlestick formation, if you simply switch to lower time frames. If you switch to 5 minutes, you will have these patterns every 5 minutes. Yes, that's why you need to calculate the number of patterns. It should be minimum 50. If you have less than 50, then you should probably switch to lower time frames. If you have more than 80, then you should probably switch to larger time frame, greater time frame. Okay. Well, that's it. Now let us examine our trading opportunity. So look at this. We have this powerful bull close when approaching this level, and it is approximately, I don't know, 75% of total range. Yes, and then we start having indecision candles. So what is the close of this candle? Yes, it is almost in the middle of the total range of that. Let me zoom it in for you. You see that? The range of that is almost in the middle, the close of that. Then we again have powerful bull close. Then again we have indecision candle. Then again we have powerful bull close. Not that very powerful, but closer to powerful bull close. Yes. Then again we have the middle close, which is indecision. Then again we have middle close. then we have powerful bull close, and then we have middle close. And also pay attention to this overlapping candles. Their ranges overlap. In a trending candles, we have one candle, next candle continues, next candle continues, next candle continues. We don't have that many overlapping. This signals us that we still have bull power, and we have indecisions. Bull power, indecision, bull power, indecision, bull power, indecision, and so on. We don't have bear power yet. Don't have bearish power yet. We should wait for a candle that will have a bearish powerful close. This will look this way and this way. Open can be here, maybe open candle of the candle can be here, or whatever. So this should be your powerful bearish close, like this. Okay, hope you understood this. And it is important, yes, that you don't have powerful bullish close, total candle body with powerful bullish close. When you have a breakout of some line, for example here, you first initially broke the line, but this could easily be a false breakout. That's why we wait for a confirmation. And when you have open and close of the body above the level, and that level has a powerful bullish close, then you have a breakout, which is a true breakout. Like here we had some small breakout, and here obviously we broke that to the upside. Or maybe here we didn't break it here, then we retraced. We had powerful bull close here, but not enough to say that we broke that downside border. But this candle has both open above the level and powerful bull close. So if we have this kind of candle that has open and powerful bull close here, then expect price to go further to the upside border. If we don't have that candle and we have a powerful bear close, then expect price to retrace back. So now let's suggest what are the retracement levels. The first retracement, in case we have a powerful bear close, where we should place our stop loss. Obviously we should place it above this upside border. We should calculate most recent penetration. Where is that? This one, yes. So most recent penetration was this. Let me draw it this way. So we have our level, and it was penetrated by this size. So the candle penetrated it this way. Yes. Then we can expect, okay, if price penetrated it here, and let me add additional buffer here, and here will be my stop loss. I know that price penetrates the level here, and then I add additional buffer, and this will be my stop loss. And let me turn it red, because it is a stop loss. Red. Don't go further. Okay, then where we should place our take profit? Entry will be somewhere here. Where? Take profit should go where? If we start reversing, yes, the most typical thing, if we don't have a breakout, then we think this level holds. If we do have a breakout, then we will look at the retest of this level. But right now we are looking at the retest of this level. If we don't have a breakout, this means open price plus powerful bullish close, then it is a retest. And what is the level below that? The level of the B point. And let me turn it green, forest green or whatever. This will be our target. Now if we will do some calculation, yes, we should have some 50% probably, yes, and then we can draw our line that maybe should be black, and this line tells us that you should not sell below this line, otherwise you won't have favorable risk to reward. So this is our limit line. We should have a powerful bearish close somewhere here, yes, inside of this zone, but we should try to enter above this line of 121.80, above this line. Maybe we will have an powerful bearish close, and then we will enter at a limit order at 121.80. Maybe we will use some other thing, and our stop, because our stop loss goes here. Okay, then how we will manage our trade. Trade management is something that is extremely powerful thing. Trade management is actually something that differentiates between professional traders and newbies. Newbies like to set the trade and forget. They want stop loss targets to be at their places, and they want to go, I don't know, sleep or whatever, and they don't like to manage the trade. Trade management is primarily your stop loss movement. It is trailing your stop loss. When price reaches your take profit distance level here, you should watch price action closely. The first thing that you need to do, you should close at least 1/3 of your position, and if you were in a trade risking $300, yes, if your total risk here was $300, when you close 1/3, you cut your risk by 100, because only $200 left at risk here. Yes, okay, hope you understand this. Then if price breaks this level, if price installs a powerful bearish close and the open of that bearish close also below that, then you can extend these targets. If it bounces, and you guys know what is a bounce is a powerful bull close of this level when you have open above that level, yes, open price. If it bounces, then what you need to do, you guys need to move your stop loss to break even, or you need to move your stop loss to your reversal point. For example, this is your top, then you need to move your stop loss to that reversal, because there is a very high probability that it will go to the upside. It may continue after breaking that B point, retracing, and it may continue to the upside. That's why you should limit your risk to break even or to whatever. If nothing of this happens, then you simply extend your targets. So you place your targets here, potentially at this line, and wait for price to move there. So 2/3 of your position should be that. And do not place your stop loss too often or too too close to your entry. Do not place your stop loss I don't know, very fast. Do not move it very fast. Wait for some price action signals. If you have powerful bull close, then yes, it makes sense. But if you don't have powerful bull close, you can have some price action, yes, like here, and you can have some spikes to the upside, to the downside, and then you can continue lower. That's why you should still have your stop loss at that level, but only if you have a powerful bull close like this. Okay, I hope this is it. All recommendations are given. Hope you will trade wisely, and hope you first backtest these patterns and actually only trade them knowing their probability and knowing their mathematical expectancy. That's it about this trading opportunity. Hope you like this video. If so, don't forget to click that thumb up button, subscribe to my next episode, click that bell to stay notified about my new episode, and good luck.